Hey, so a bear market is when the stock market is down 20% from its highs. A correction in the market is when it's down 10% from its highs. Right now, the S&P 500 passed a couple weeks ago down 20% or more from its highs, which means we're in a bear market territory. Bear markets can last a long time, or they can be very short. In 2020, we had a bear market that lasted 11 days. But during the financial crisis, the bear market lasted over 600 days. So it just depends on the situation. Ultimately, how do you handle a bear market? In the end, it all starts with planning. Do you have a financial plan in place? I'm not talking about a plan that maybe a stockbroker would put together. I'm talking about a real financial plan, one that says, hey, I'm saving X. I've taken into account bear markets in my calculations, and I can receive, or I can get to Y by saving X amount per month. The financial planning process for retirement planning is fairly straightforward. We do that for all of our clients here, including comprehensive planning, where we cover other areas like estate planning and tax and insurance planning. But ultimately, times like this is what people notice the most, because you look at your portfolio, you could be down 20, 23%. Most conservative portfolios are down like 14% right now. So ultimately, what do? One is you review your plan. If you continue to save the amount that you're saving, can you reach your retirement goals? If you're in retirement, do you have enough cash reserves to weather the storm? Two, turn off all financial news media. Stop paying attention, because if your plan is working, which you just checked to make sure that it was, ultimately, we don't need to be hyping yourself up on all the stuff that we see on CNN, CNBC, Fox Business, Fox News. It doesn't matter. We need to stay informed, maybe glance at the Wall Street Journal occasionally or a local article talking about the markets, but ultimately we cannot hyper-focus, because this is going to cost you money in the end. Ultimately, when you invest long-term, there's a price that you have to pay, and that price is volatility. We know that in the long term that the S&P 500 especially does great, but we have to get through times like this. And in order to get through times like this, we have to have a little perseverance, a little stubbornness, that we believe in long-term capital markets. I don't know anybody out there who doesn't believe in long-term capital markets, anybody of significance, any of the big firms that analyze markets and economies. Ultimately, though, we just can't be short-sighted. We can't focus on 3-month, 1 year, maybe even 3-year returns. We have to focus on 10+ year returns. Money that you need the next 5 years probably shouldn't be invested in the market. It probably should have been in cash, so that you don't experience the volatility. It gives you confidence that in the short term, you can meet all your obligations. Ultimately, financial planning, goal setting is all very individual. So all this is just very general advice. But ultimately, you cannot get wrapped up in everything that you see, because as soon as possibly the Fed stops raising rates, or there's going to be a catalyst that pushes the market right back up again, and then you're going to be holding cash at the top, as opposed to being invested all the way through, being able to recoup your money. Thanks for watching.